GDP report is out today. It shows the U.S. economy grew at 2.3%, a 2.3% rate in the final quarter of 2024, down from earlier in the year. Consumer spending surged 4.2%, but high inflation, high interest rates are putting a strain on lower income households. Joining me now, Anthony Saccaro, president of Providence Financial and Insurance Services. Good to have you. So what do you think is driving the stronger consumer spending despite inflation and despite high interest rates?
Well, the fact is that wages have gone up over the last couple of years because of the fact that the labor market is so tight right now. It has come down. Right now, there are currently about 1.25 jobs for every worker that's available. But if we were interviewing a couple of years ago, that number was closer to almost 2 jobs available for every worker. So what that means is that in order for companies to keep good workers, they have to hire people at higher rates or give more raises than normally they would to keep good workers on. So over the last couple of years, wages have outpaced inflation. And that just means that the consumers have more money to spend. And when you're in an economy where GDP is 70% driven by consumer spending, and consumers continue to spend, then GDP is going to continue to be robust, and that's exactly what's happening.
Well, let's look at the Federal Reserve yesterday. Jerome Powell decided to keep interest rates steady. Yesterday, 4.25 to 4.50%, even though President Trump said he was going to tell the Federal Reserve to lower interest rates. Hasn't happened yet. We'll see what happens next. But what do you think this means for the economy moving forward, keeping the interest rates the same?
Well, I think it's a good move. The challenge that the Federal Reserve has is they need to be ahead of the 8 ball. This is the problem they had before when COVID happened. They thought inflation was transitory. You remember that word from a few years
Oh,
ago, I'm
yeah.
sure. And the reality is that it wasn't transitory. And so they got way behind the 8 ball. Inflation got into 9% range at one time. And now it's dramatically come down, but it's still hovering much higher than their 2% target. CPI, I think the last reading was 2.9. Now, they can't wait for inflation to get down to 2% before taking action. Inflation is a lagging indicator. Inflation, the effects of what you do today are going to show up in inflation 6 months from now. So they have to be ahead of the 8 ball. And I think they are ahead of the 8 ball at this point. GDP, which is how strong the economy is, although it's still robust, has come down. It's significantly lower than it was for Q2 and Q3. So that's good. The economy is slowing, which is where they want it, but holding off for now and taking a wait and see approach to see where GDP goes and to see how all of the Trump administration's rhetoric and policies actually work their way into the economy. I think it's a very smart move. So he
Okay.
did what he had to do.
Good. Switching gears a little bit, you own an insurance agency in California. You know firsthand about the insurance crisis, which has been worsened by the recent LA fires. Many companies have left the state or non-renewed clients due to two key factors, right? First, risks have not been adequately mitigated. Second, the state imposed price controls on insurers, making it practically impossible to do business. And now residents are suffering. What's next for the industry, do you think, and homeowners?
Well, there's a couple of different issues. I feel bad for the people in the fire areas that maybe State Farm or one of the other insurance companies cancel their insurance. And you know how it is. You get your insurance canceled, you get irritated. It's like, now I got to go find a new company. And then maybe that never happens. And I'm sure that there were some people that just procrastinated their way and didn't have insurance. But what's happened is there was regulation prior to that didn't allow insurers to price for catastrophes. And recently there was a law change that actually allowed them to increase their prices for catastrophic events like this. And I think that's going to help. But the reality is these are catastrophic events that can wipe out insurance companies. And so when a State Farm or when one of these large insurers, farmers, pulls out of the state and they leave people hanging, the only option they often have is the California Fair Plan, which is
Yeah.
a government-run program.
Yeah.
And right now, there's $350 million of assets. They're broke, so they're not ones to rely on.
Okay, so potential
Rely on.
exposure. Speaking of the FAIR Plan, their last resort insurance for people in high fire risk areas, potential exposure of $4 billion in the Palisades area and potential exposure of $775 million in Eaton. What does that mean for taxpayers?
Well, it means that California Fair Plan doesn't have the money to pay them. It means that ultimately California is going to have to step in and help to fund it. And I have no doubt that they're going to do that. But where are they going to get the money from? Of course, the answer is taxes. And that means that our taxes are going to go up as well. So
Lovely.
individuals that are in fire areas, I'm in a fire area and I'm worried about being dropped and my taxes going up at the same time.
and a state where taxes are already the highest in the country. Great planning, great management. Anthony Saccaro, president of Providence Financial and Insurance Services. Thank you for your insight and time today, as always.
Thank you, Alicia.
Want to see more videos like this? Visit OANN.com for immediate access to all the clips you've been waiting to see.